The reversal didn't start with a breakout, it started with silence. The charts were flat that morning, almost boring. XRP had already endured the slow bleed, weeks of drifting lower, while commentators recycled the same tired narrative. Regulatory pressure, fading momentum, institutional disinterest. Most retail investors over 50 I speak with were exhausted, not panicked, just tired, the kind of fatigue that makes you consider selling simply to stop thinking about it. And that's when I noticed the shift. No headline, no celebratory analyst upgrade, just a subtle thickening in the order books. Bid walls appearing below price, not aggressive, not flashy, just patient. The kind of liquidity that doesn't chase. It waits. At 2:46 a.m., I watched the depth chart tighten, spreads narrowed, sell pressure weakened, but price barely moved. That's when I understood. Someone wasn't trying to move XRP higher. They were trying to accumulate it quietly. Hours later, derivatives data began to reflect something even more interesting. Funding rates stabilizing while open interest increased. That's not retail behavior, that's positioning. Meanwhile, financial media continued speaking in past tense about XRP's potential, as if the decision had already been made. But markets don't whisper before they collapse, they whisper before they turn. And what I found digging into wallet flows and regulatory timelines changed the way I see this entire setup. Because this isn't about a quick bounce, it's about who's getting positioned before the narrative flips and who's going to realize it too late. I've seen accumulation phases before. They never look dramatic. They look like boredom. XRP wasn't pumping. It wasn't crashing. It was hovering in a tight range, frustrating both bulls and bears. That's usually when retail interest fades, volume drops, comment sections quiet down. But the blockchain doesn't get bored. I tracked several high-value wallets, increasing holdings incrementally over a 72-hour window. No large spikes, just consistent inflows from exchanges into cold storage. That's a signal. Retail investors sell into frustration. Institutions buy into it. What stood out wasn't just the accumulation, it was the restraint. No attempt to push price upward. No attempt to create buzz. Just steady absorption of supply. That tells me one thing. Whoever was buying didn't want attention. And when capital avoids attention, it usually has a timeline the public doesn't see yet. The regulatory environment hasn't vanished, it's evolving. I reviewed recent filings and policy discussions surrounding digital assets in the United States. The tone is shifting from confrontation to framework building. That matters. For investors between 40 and 80, regulatory clarity isn't abstract. It's the difference between speculation and legitimacy. When the conversation moves from ban or punish to define and regulate, risk models change, slowly at first, then decisively. I noticed that XRP's price stopped reacting negatively to regulatory headlines that would have crushed it months ago. That's a behavioral tell. When bad news stops pushing price lower, it means sellers are exhausted, and exhausted sellers create opportunity for prepared buyers. But that's only one layer of what's happening. Most retail investors watch the spot chart. I watch derivatives. Open interest began climbing while volatility compressed. That's coiling energy. But funding rates didn't spike aggressively positive. That means longs weren't euphoric. They were strategic. Short positions remained crowded, leaning on the assumption that XRP would drift lower indefinitely. It's comfortable to bet on continuation when momentum has been negative for weeks, but markets punish comfort. The imbalance wasn't extreme yet, but it was building. And when positioning builds under a stable price, it often precedes a violent repricing. The question isn't if volatility returns, it's who it will hurt most. I pay close attention to tone. Financial media was still framing XRP as a recovery story that failed to recover. Analysts referenced past highs with a subtle smirk, implying the best days were gone. But price wasn't confirming that narrative anymore. This disconnect fascinates me. When commentary lags structural shifts in liquidity, it creates a psychological trap. Viewers internalize negativity while the market quietly stabilizes underneath them. I've seen this before in traditional equities. By the time the coverage turns optimistic, the bulk of the move is already priced in, and that lag is where asymmetric opportunity hides. I read comments, I listen to calls, I speak with investors who've lived through multiple cycles. The dominant emotion wasn't fear, It was resignation. That's more dangerous. Fear creates sharp sell-offs. Resignation creates slow liquidation. People reduce exposure quietly, convincing themselves they'll re-enter if things improve. But improvement rarely announces itself politely. The older investor demographic understands patience, but even patience erodes under prolonged stagnation. And when disciplined investors begin doubting long-term positioning, institutions take notice. Because emotional fatigue is a liquidity event. Institutions don't chase stories, they chase mispriced risk. If regulatory probability improves even marginally, and if retail sentiment is deeply pessimistic, that's a favorable setup. I noticed correlations tightening between XRP and broader market stability indicators. It wasn't acting isolated anymore. It was behaving like an asset preparing to re-enter larger allocation discussions. Portfolio managers don't need certainty. They need improving odds. And improving odds don't show up on television. They show up in positioning data. Something subtle happened last week. XRP stopped making lower lows. That sounds simple. But structurally, it's profound. Downtrends persist through continuation. When continuation stalls, narrative pressure builds. Bears must defend their thesis actively instead of passively. I watched as short-term rallies were sold, but with less aggression each time. Liquidity below price thickened. That's not random. That's defense. And defense often precedes offense. The institutional reversal doesn't begin with a headline. It begins in a conference room you'll never see. I've watched this pattern play out for decades. In equities and commodities and credit markets, the public thinks reversals start with a news alert flashing across a screen. They don't. They start with allocation committees quietly adjusting exposure by a fraction of a percent, a half point here, a measured reweight there, nothing dramatic, just enough to matter over time. It begins when legal teams sit down and reassess risk, not in emotional terms, but in probability matrices. When the question shifts from, could this destroy capital, to, is this risk now manageable within mandate guidelines? That's the inflection. That's when something moves from untouchable to cautiously investable. That shift never trends on social media. It moves through spreadsheets, it moves through compliance approvals, it moves through carefully structured orders designed not to disturb price. It begins with capital flowing in before commentary changes, before analysts upgrade ratings, before anchors adjust tone, before retail feels comfortable again. And right now, XRP feels like it's sitting inside that quiet corridor, not explosive, not euphoric, transitional. The volatility has cooled, the panic has faded, the ridicule has lost its sharp edge. Price isn't screaming higher, but it's no longer collapsing under pressure either. That's not stagnation. That's stabilization, and stabilization is where professionals position. Transitional phases are invisible until they're obvious. By the time they look clear on a weekly chart, the reallocation has already occurred. The easy asymmetry is gone. The market doesn't announce when it changes its mind. It simply stops falling and waits to see who notices. Here's what I believe after watching this unfold. Not from emotion, not from hope, but from pattern recognition built over decades of market cycles. The opportunity window isn't during the breakout, it's before it. Breakouts are visible, they're loud, they attract coverage, commentary, and confirmation. But by the time price expands aggressively, the risk-reward dynamic has already shifted. Early positioning becomes late participation. I'm not promising a surge. I don't deal in guarantees. What I'm recognizing is a structural shift in probability. Liquidity is stabilizing instead of evaporating. Sentiment isn't euphoric, it's fatigued. Regulatory tone is no longer escalating. No, it's evolving. Positioning in derivatives markets is tightening, coiling like compressed energy. That combination doesn't guarantee upside, but it changes the risk equation. And investing, especially for those who've lived through inflation shocks, dot-com collapses, housing crises, and pandemic volatility, is about weighing risk, not chasing certainty. If you've been in markets long enough, you know the pattern: ridicule, fatigue, stabilization, reprice. First they mock it, then they ignore it, then they slowly adjust, and finally they explain the move after it's already happened. So here's my warning: And it's not dramatic, it's practical. If you wait for institutions to confirm their reversal publicly, you'll likely pay a premium for clarity. Institutional confirmation arrives in quarterly reports, allocation disclosures, and softened analyst tone long after capital has quietly repositioned, because by the time the headlines declare the turnaround, the accumulation phase will already be over, and what felt risky at the bottom will feel obvious at a much higher price.